Okay, all right. So it seems I'm unmuted. I've been talking to myself for the past 2 minutes. Great. So good afternoon, everybody. Here it's 12 p.m. here in New York City. I'm excited to have everybody here. It seems like a very international gathering of traders, of Orbex traders, and we're getting more people joining us, which is great. So before I get started and talk to myself for another 2 minutes, let me do another quick sound check and get you participate in our chat. Can you please type in a Y in your little chat box on the webinars widget if you can hear me? Just type in a Y in your chat box. So first of all, I'll notice you that you are here, and second, we will get our sound check going. The little chat box over here, we're getting yes that you are hearing my voice. Okay, great. So thank you all for attending. And I'm very excited to have you all. First of all, let me tell you that this is going to be an interactive webinar. I want you to definitely jump in and ask questions and answer questions and tell me your story as we move on, and just stop me whenever you have a question, because you know, that is the best way to learn, and it also gives me a good feeling that what I'm teaching is actually being received. So that's going to be great. It's going to be a great webinar. We're going to talk about today about, we're going to have a quick introduction about myself, about Orbex, and for those of you who are new to forex trading, let's see how many people we have here who have never traded forex before. Type in a yes, type in a Y for yes if you have never heard of, you've never traded forex before. We're getting no Ys, which is great. Okay, so I'm assuming that all of you up until now, where we are having more attendees joining us, have traded forex before, but still we're going to have to do a quick recap of the terms and the market introduction for those of you who've forgotten, and for those of you who just want to brush up on their forex vocabulary and their forex knowledge. And then the main focus of today is going to be reversal chart patterns, which is one of the basics of technical analysis. We had a webinar only on technical analysis before. Hopefully you were able to join it. And once we're done introducing the reversal patterns, I'm going to actually walk you through live in the market and show you how to set stops and limits, how to set profit target on your trades using reversal chart patterns. So before we get started, please grab a pen and a paper to take notes. If you have a forex trading notebook, that's great as well. You can just accumulate all the notes you've been taking from previous webinars, from other webinars, and everywhere you've been learning forex from. So you basically don't forget. This is exactly like school, and education is very important in order to be able to trade responsibly. Forex is a risky trading market, so as any other investing in trading, and the best way you can prepare yourself is by educating yourself, and nobody can take care of your money better than you do, because nobody cares about your money as much as you do. So grab a pen, and once you're ready, type in a Y so we can just go. Are we getting Ys here? Type in a Y for yes so we can just go. Let's see, what time is it? Yeah, it's 6 minutes through the webinar started, so we are going to just get started with Orbex, with an introduction to Orbex Trader Library that is going to go live potentially by tomorrow or by the end of this week by latest, which has a directory, a full directory of education material, videos, ebooks, infographics, trading tips and analysis, The education videos are done by myself so that you know what I look like. It's going to be great. If you miss any other videos, you should definitely check out the education videos. And also, Orbex has daily technical analysis tips, fundamental tips that if you subscribe, you will get them right in your mailbox, which is going to be a smart step towards responsible trading and in order to be informed before making trading decisions. So here is a little bit about myself. Well, probably a lot of you don't know me yet. So I do want to introduce myself because then I want to hear from you. I'm just going to open up a little bit so that you feel comfortable opening up at the same time. And the reason why I want to introduce myself and my story of how I got into forex trading is because it really speaks to people who are scared of trading, and we're in it all together, and nobody is obviously perfect, but forex trading is very easy as long as you're educated. So what happened to me was, well, right now I'm the founder of InvestDiva, and I've published a book, a sold-out book by McGraw-Hill here in the U.S., which was sold out internationally, actually, InvestDiva's Guide to Making Money in Forex. My mission was to educate beginners and women alike to basically trade responsibly. How many women do we have here in the audience? Tap on Y if you're a woman. All right, we have a bunch of dudes here today. That's great. But definitely next time you attend our webinar, try to bring your wife, your daughters, your girlfriends as well, because forex trading is definitely not gender specific, and everybody can be successful forex traders as long as they're educated. And I started trading as a hobby while I was studying electrical engineering in Japan. And I had no idea about the financial market whatsoever. It is years ago. But when the markets crashed in 2008, I was just hearing that the dollar is going down, and I had accumulated a bunch of yen, Japanese yen at the time, and I was thinking to myself, if I ever want to go to the U.S., this might be a good time to change my Japanese yen into dollar. And I was thinking, what is the best optimization of doing this? The market is going down so rapidly. When is going to be the bottom? When should I sell all the yen? And all of that. I was talking about this out of nowhere to my host family's Japanese mom, and she told me that she actually uses this opportunity by forex trading. At the time, I had never heard of forex. I'm like, what is forex? Is it for your ex? Are you doing anything for your ex? Turns out it means foreign exchange trading. And she helped me making my first $10,000 in less than a month. And that is how I got very interested in forex trading and trading in general. Decided to come to New York, and basically throwing away my electrical engineering degree, 6 years of studies is just thrown out in the trash can, and now I'm a full-time forex trader and educator and a media personality for that matter. So my point is that even though I had no background whatsoever in forex trading, I was able to learn it from my Japanese mom, and ever since it has been a very exciting journey. Every day I wake up right now knowing that the opportunities are endless. The market is going to go on 24/5 until Friday, so I don't have to worry that the market is going to close at 4 p.m. or any of that. So that actually brings us to the next slide. What is Forex? You probably already know. I already said it. It's foreign exchange trading currencies in the international global currency system, the largest market in the world, 53 times larger than the New York Stock Exchange, and over $4 trillion worth of transaction on a daily basis. So this market is deep. It wouldn't crash, and the beauty of that is that it gives us the opportunity to make money on the way up and on the way down. We are going to get into that later, which is actually the focus of this webinar, how to make money on the way, on the rebounds, on the reverses. So just to give a brief introduction for those of you who are here for the first time, who are brushing up on their forex knowledge, the currency market, the major currency pairs that are the mostly traded currencies in the world there are 7 of them, as opposed to thousands of stocks. It is the European currency, the single currency, the US dollar, obviously, the Swiss franc, the Japanese yen, the New Zealand dollar, the Australian dollar, the Canadian dollar, and the British pound. So these are the major currencies, and then when they pair up together with the US dollar, they are called the major currency pairs. If US dollar is not participating in the currency pair, they are called the minor currency pair. So if we have the euro versus the Canadian dollar, that will make a minor currency pair. But nonetheless, these are the most largely traded currency pairs. There are other currencies, obviously, over 200 more currencies that are called the exotics, that they are also available on Orbex trading platform for those of you who are interested in trading the exotic pairs. So again, a little bit more on advantages of forex. As I mentioned before, it never stops. It's 6 days a week. It starts Sunday night New York time. That is the market open in Australia and Singapore, and it ends Friday evening at 4 p.m. in New York again, which basically is the end of the trading week. So it doesn't stop during the nights and the days, so you can trade anytime, anywhere, on your laptops, on your iPads. Great opportunities all the times, especially when we go from session to session, when we go from London session to New York session. There are great opportunities. Then when we go from the New York session to the Asian session, again, other opportunities. So opportunities all the time. And the other thing about forex trading that I always have to repeat myself, the high leverage that is available for forex traders that is not available for any other kind of trading is a blessing and a risk at the same time. If you use leverage and the market moves in your favor, it's going to be great. You're going to multiply your profit by maximum of 500, depending on the country that you're in. In the U.S., our max is 50. In Japan, it's 20. In some other countries, it's 100. And in Cyprus, I believe, it's 500. I've never traded there before. I would definitely like to go there. But at the same time, you need to remember, don't forget that leverage is a double-edged sword. And if you lose money, that is going to multiply your losses by the same amount. So with that, now that you are clear about the risks of the forex market, we are going to teach you how to make money in the forex market, because that is the most important thing. That is why we're all here. We want to make money. And we make money in forex when the markets move up. That's basically, it's any other market. You make money when the markets go up, right? But the beauty of forex is that you also make money when the market goes down. Why? Because you, for example, if you're trading the euro dollar and euro is going down, guess what? Dollar is actually going up then. So that means that you can make money when the euro is going down by selling it and basically buying the US dollar, for example. This is just an example, but the importance of that is that the market, the currency market moves in cycles. What goes up must come down, and what goes down must come up. It's, again, a little bit different than the stock market, that eventually, over the period of time, it eventually moves up. But that is why forex is very interesting, because you can expect every market, if you stay in it long enough, which is not the main purpose of a forex trader, of a day trader anyway, but if you stay there long enough, you can expect the market to go back to the place it was before. We've seen it with the US dollar, we've seen it with the British pound, with the Australian dollar. All of them go up and they go back down. This rule does not necessarily apply to exotic pairs. Some exotic pairs have different rules, but what I'm talking about right now, the market moves in cycles, is the major currencies, basically the major currency pairs and the minor currency pairs. So that's how you make money. You identify the top, you identify the bottom, and bam, you get into the trade and make money. So how do we identify the tops and bottoms? This is what we're here for. Today we're talking about technical analysis. We did have a webinar about fundamental analysis, which I also encourage you to learn more about it. The best traders are the ones who combine technical and fundamental analysis all together. But today we're talking about technical analysis. A short introduction to technical analysis is basically that it isn't the art of using history to predict the future. A fundamental analyst listens to the radio, to CNBC, to Bloomberg, to the news, to see what is going on in the economic global market, who is talking. Today we have the FOMC statement, for example, that is going to make a lot of volatility in the US dollar. But a technical analyst, if it's a solely technical analyst, would disregard all that and only study the chart patterns. What is a chart? Chart is basically the platform that enables you to organize all the data and the past behavior of the market. Technical analysis is basically the belief that the history is going to repeat itself. If it happened before, it's going to happen again. That is technical analysis. So here I have two ancient charts that were used, that people used before. Still a lot of people use them now, but right now most people use candlesticks. The history of charts, the evolution of charts started with line charts that you can see here. A line chart only shows you the closing price of the market in a specific time period. So for example, this is the euro-dollar hourly chart. And here the dots, the red dots are a little bit small. Probably you cannot see it properly. The small dots over here shows the closing price at the end of each hour. So the market went from here to here to here to here. So this didn't give the traders any history of how the market behaved during that time period. That is how the scientific traders invented the bar charts, which basically shows you the market close, the market open, and the whole range the market traveled during that 1 hour. This is a very small one. We're going to move into the next slide to show you the candlesticks, which is the most recent. It is not actually that recent. The candlestick charts, hold on one second. How do we go to the next one? Okay. All right, so the candlestick charts were actually invented by, where do you think the candlestick charts were invented? They were invented in Japan. They were invented in Japan not recently, but in the 16th century by a Japanese rice trader. So they had nothing to do with forex trading, but he did help develop a system that eventually in the 21st century was helpful to online traders. The candlestick is basically very useful because you color in between the market open and the market close areas, that range, so that by a glance, when you take a look at the candlestick in a glance, you know if the market generally went up or if the market generally went down. So traditionally, the white candlestick, as you can see in this chart, the white candlestick shows that the market generally went up. The black candlestick showed that the market generally went down. All right? And then later, as people became more net savvy and web savvy, they started coloring inside the candle with different colors. So generally right now in the stock market, the blue color means that the market generally went up. So if we are looking at an hourly chart, for example, this one is a 4-hour chart. If we are looking at a 1-hour candlestick chart, that means that this candle, it took it 1 hour to develop. It opened at this price at the bottom. It closed at this price. it moved within this range. This is the high and this is the low, and it closed at this price. And the market, obviously, because the color is blue, the market generally went up. Same with a bearish candlestick. That's what we call a candle that shows the market generally went down. The market closed at this price. It moved within this range. It went up, it went down, and eventually it closed at a lower price. So therefore, this candlestick is colored red. Personally, I prefer using candlesticks using purple and green colors because, you know, it's just self-preference. But be careful if you're changing the candlestick colors on your Orbex platform. Be careful that you know what those colors exactly means, because if you change them too often, chances are you're going to get confused. So stick to one color and just go with it. And we are going to right now tell you more about how to use the candlestick charts in different time frames. So the beauty of technical analysis is that not only it gives you a vision, a view of past market behavior, but you can also go through different time frames. So we just said that one candlestick shows the market behavior in a specific time frame, right? So take a look at this one, this chart on top left. This is the euro-dollar chart, the 30-minute euro-dollar chart. What does this mean? This means that each of these candles that you see here, for example, take a look at this long green candle. What is this? Is this a bearish or a bullish candle? The color is green. I have chosen the color green to indicate my bullish candle. So this means that during this 30 minutes, this chart is actually from today, during this 30 minutes, the market generally went up. It opened at this price. It closed at this price, and it did move within the higher range. You can see the shadows of the candle went all the way up here, but it closed at this price. Then the next candle, then the next candle. Same goes with the 4-hour chart. This is the same euro-dollar chart from today, but you can see that the chart pattern is completely different from a 30-minute chart to a 4-hour chart. Why? Because this shows more micro market movements, while a 4-hour chart, each of these candles, it took them 4 hours to get built. So in the past 4 hours, the market actually generally went up. 4 hours before that, also the market went up, right? But the 4 hours before that, the market generally went down, right? Then you can take it to the next step and look at the daily chart. If you're a longer-term trader, you use a daily chart. Each of these candles over here shows the market behavior within a day. So yesterday the market went up, the day before that the market went up, the day before that the market went up, and the day before that the market went up. But the day before this, which was, as I believe is October 24th, the market was completely indecisive. So this candle opened and closed at the same price. So it wasn't able, the bullish and the bearish investors were not able to make a decision and move the market. And that was actually an indication, as you can see here, the market was going down until we hit this indecisive candlestick pattern that we did talk about in our previous webinar as well. This was an indication of a market reversal. This candlestick by itself showed us the market is indecisive. After a period of going down, the market is indecisive, and the next candlestick was bullish. So we could have been almost certain that the market is going to move up as it did for the next few days. So studying the candlesticks are one type of technical analysis. Today, we are going to focus on the candlestick patterns. Let's take a look at these charts over here. Do you see any kind of pattern over here? I want you to look carefully. So take a look at this euro-dollar chart. Any pattern do you see? Does it look like a triangle? Does it look like a round table, a rectangle? What does it look like? A lot of you might say nothing. It just looks, markets are just moving in a completely not organized movement, which is true in a way. But if you look at it closely, a lot of times you can identify different patterns. So today we're going to introduce you the reversal patterns, which means that when they show up in the forex chart, you can expect the market to reverse. So basically, if the market was going up, after identifying the reversal pattern around here, you can expect the market to go down. So here I have this quote that the trend is your friend, right? How many of you tapping a yes? Tapping a Y for yes if you have heard of this phrase, the trend is your friend. Yes? Yes from Ziad, thank you so much. Yes, so the trend is your friend until it's not. Until you hit a reversal pattern and the market goes down. It is not a bad news for forex traders because, as I said before, you can actually make money when the market reverses as well, which is actually one of the most powerful trading strategies out there. So the reversal patterns work both ways. You can either expect a reversal pattern during an uptrend, which would reverse that uptrend into a downtrend, or you can expect a reversal pattern during a downtrend, and that pattern that would probably like appear around here would reverse that downtrend into an uptrend. So today we're going to focus on the 4 most important reversal patterns. They are double top or double bottoms, triple top or triple bottom, head and shoulders top or bottom, saucer top or saucer bottom. So are you guys with me? We are going to dive into each and every one of these reversal patterns. We are going to start with the doubles. Very cute. This is not how they were actually identified, but there must be a reason why they call it doubles, because as you can see, a double top pattern kind of look like a double top of a twin doggy over here, right? Like 1 top, 2 top over here. A double bottom pattern, you see, 1 bottom and 2 bottom, kind of looks like these bottoms of the dogs over here. But remember that the double tops and the double bottoms, obviously they cannot happen at the same time on the forex chart. You can either have a double top pattern or a double bottom pattern formation. Another way to remember a double top pattern and to identify it easily on your forex platform is that the doubles typically look like a letter M. You see? The large M over here. So you have 1 top, a valley over here, and then another top. And the double bottom chart pattern typically looks like a W, right? You have the bottom over here, a peak over here, and another bottom over here, and then the market reverses. So let's take a look at the double bottoms, the double top chart patterns on real chart. Take a look at this. This is a snapshot. Let's take a look at the one on the right side and the left side first. If I had not circled, identified the double top over here, you probably would have looked at it and say, okay, I don't see nothing, right? But if you look closely, the market was going up. We did have a general option over here. The market hit this level, the 1.2625 level, then it went down. The market was completely unable to break below this level. You see, it went down, it went up again, it tried to break this level, it couldn't, it tried, and then it went back up to this level, again, to exact point of 1.2625. And then it went back again to this support level. Here is when I look at the market and say, wow, this level over here, let me highlight it. This level over here, we call it the neckline. And it's obviously a very powerful, strong level. And here is when I'm going to be cautious, because if the market this time is going to be able to break below this level, that means that our double top was confirmed and the market is going to reverse and move down. And guess what happened? Guess what happened over here? The market went up, the market couldn't break the neckline, the market went up again, the market then broke the neckline, And typically, when the market breaks the neckline, it moves down the same amount. Look at this arrow, the same amount of the range between the neckline and the top. So basically, what you have to do when you identify a double top is to measure the distance between the neckline and the top and set your exit strategy at the same distance, but this time in the opposite direction. And guess what happened over here? The market moved down exactly to that same amount. I got out of the market at 1.2500 and I was happy about it. The market went back up again, but guess what? I made money on the way down, which was great. So this is one reversal pattern strategy. I'm not saying that this is the only strategy. You always have to mix and match and identify and confirm your identifications with other chart patterns and other technical analysis and other fundamental sentiment analysis as well, but this is one method. Okay? So, let's go back to our mouse over here. Double bottoms behave the exact same way as the double tops, but in the opposite direction, right? So take a look at this chart from February 23rd. The market was moving down. It was on a downtrend. It hit this bottom level. It went back up. It hit this level, which could have actually been a different level as well. So we talked about Fibonacci retracement levels this last week. That could help you identify the neckline as well, right? They coincide at the same time. We're not going to confuse you right now, but we're just taking a look at this chart pattern formation. Market went down to the bottom, went back up to the neckline, it went down to the bottom again, and then it kind of broke the neckline over here. You see? This very strong bullish candle that is trying to peak above this neckline. So at this time, I'm still not sure if this is a confirmation, a confirmed bottom, double bottom. Why? Because sometimes the markets give you false breakouts, false alerts. So sometimes even though the market tries to break this key resistance level, but sometimes it comes all the way over here, and then in the next period, it starts a bearish candle. So right here, I did not put my entry order yet. I waited for the market for the next time frame, for the next period. And right over here, I saw that the next candle, you see this one, was it opened above the neckline. So this was a very strong signal and indication that the market has been able to break above the psychological barrier, the psychological neckline, the psychological resistance level, and is probably going to move up. So around here, I set my trading order to get into the market around here to basically buy. This is going to be a buy position, right? Because this is a reversal pattern. The market was going down, now it's going to go up. So I'm going to get into the market in the buy position, the bullish position. And as always, again, I measured the distance between the neckline and the bottom. I measured the distance between my entry order and my limit order, which is where I'm going to get out of this market. And then I sat down and watched the market go up, which was great because I entered the market right over here. The market went out around here, 0.9100. I got out of the market over here. The market did go up after that. But you know what? Chances were that the market wouldn't have gone up. Remember in the double top over here, the market hit my target and then they reversed again. So if you want to be greedy, you have to be very careful because sometimes you can get lucky and the market will continue to go up, but more often than other, the market can actually reverse and you can lose money. The market could have just gone back all the way over here. So it's better to be safe than sorry, and it's better to actually measure the distance and measure your limit order and set a stop and limit order when you're trading responsibly. So here I mentioned stop as well, so let me get into that as well. When you're trading based on a double bottom, if you're getting to the market, if you're entering the market in a buy, in a bullish position at the neckline, you want to set your limit, your exit strategy, your exit the same distance but on the high over here, and you want to set your stop loss order at the same distance over here. So I had a stop loss around here, right? But that also obviously depends on your own capital and risk appetite as well. If you don't have enough money to be able to basically to be able to tolerate any kind of loss, then you want to get out of the market the minute it turns back. But this is one of the basic methods to set, stop, and limit orders. Do we have any questions up to here about the doubles? Double top, double bottom, everybody good? Everybody understand what a neckline is? Top and Y if you understand what a neckline is. Is it your neckline or is it the double top neckline? If you had a twin, that would be your the level of your both necks, right? So that is why they call it a neckline. No questions? Okay, great. So we're going to move on to the next chart pattern, which is triples. Basically the same, but this time instead of 2 tops, we have 3 tops. And instead of 2 bottoms, we have 3 bottoms. You see, this is like an extended M. 1 top, 2 top, and 3 top, and then the market reverses. You see, this is why, for example, if the market was up to here, and we only had 2 tops, and the market didn't confirm a break below the neckline, that is why you want to wait for the confirmation. And if you did actually get into the market at the end of a double top, that is the reason why I told you to set your stop order at the same distance, so that if the market goes up and then goes back down, you don't allow the market to go screw you over, you know. So if you had your limit order a little bit above this level, your stop order, I'm sorry, if you had your stop order a little bit above this level, then you would have been fine, and you could have actually waited for the market to form a triple and to reverse. Same goes with the double bottom. Let's go to the next slide, which is more self-explanatory. So here we have the number 1 top, number 2 top, and then the number 3 top. And this level, this is a very strong level. Why? Because the market went up, tried to break through this level but couldn't, went up again, tried to break through it again but it couldn't, went up again, and then it broke it. So this makes this level a very powerful psychological level between traders and investors. You see, so traders, the technical analysis is basically trading the trader's psychology, the investors. So this neckline is a psychological invisible barrier that you want to identify. And guess what? When the market is finally able to break below this level, this is a support level up until here. But the minute the market breaks below it, this level turns into a resistance level, right? So next time when the market wants to reverse, it has to again go through and break through the psychological level as a resistance level. So you want to keep that in mind, okay? So here we're going to take a look at the triple tops in action on a candlestick chart. So as you can see, the market was on an uptrend, and it hit this barrier, it hit this level. You see, this time the triple top are not at the exact same level, but they're almost at the same level. They're all below the 1.0350 level, and they're all above the neckline, and you can vividly see the valleys over here. So this is a triple top. And then what happened? The market, after the triple top, had a very strong bearish reaction. It broke below the neckline, and then it confirmed it by opening the next candlestick below the neckline. So around here, I would have been kind of sure that the market is going to move down. I would measure exact same way that we did with the double top pattern. I would measure the distance between the neckline and the tops, and I would stop and I would set my exit strategy, my limit order at the same distance so that I don't get burned just in case the market wanted to change direction. But obviously if the market continues to go real down powerfully, then you can get into the market again. But this is just one of the strategies that you can use, setting your limit order the same distance from the neckline as the distance from the neckline to the top. So that was a successful triple top identification in trade order. Next one is the triple bottoms. Again, same as the double bottom. You identify the 3 levels that the market tried, wasn't able to go down. Then it broke above the neckline. This neckline over here is the resistance level, you see, because it is stopping the market to move up. And then this level, after the market breaks above the neckline, will turn into a support level this time, right? So this goes on and on over and over again. So you'll have a triple bottom, it will go up to a triple top, it will go back down to a triple bottom, and the game continues, right? So let's go to the next one. Enough with the triples on the bottom and the tops. We're going to introduce you not to a shampoo brand, but to another reversal chart pattern identification. It's called the head and shoulder because it kind of looks like 2 shoulders and a head. Well, I know that these are hands, but I couldn't find anything better than this. So if you see something like this on your chart where the guy is peeking up, shoulder, head, and shoulder, that is the head and shoulder top. If you see something like this on your chart, a shoulder, a head, and another shoulder, that is a head and shoulder bottom. Let's see what I'm talking about. Do you see the resemblance? Probably not, but head and shoulders top is very similar to the triple top, but the only difference is that the head is slightly higher than the shoulders. The shoulders are typically the same range, and the head kind of peaks up. Over here, the neckline is exactly the same. It will turn into a resistance level after the confirmation of the pattern. And this is a bearish reversal pattern, which means the market was going up. You identify the market. You get into a sell position around here. The same like as setting your stop and limit orders with the triple tops. You measure the distance between the neckline and the head and the top, and you set your limit order the same distance over here. You make your pips, and you get out of the market happy, right? So there is another trick, though, about head and shoulders top, is that even though the necklines for the triple tops and triple bottoms, and the double tops and double bottoms were always almost a straight line, with head and shoulders, actually, if the neckline is not straight, and if the neckline, the slope is down, that typically produces even a more reliable signal because the market was going up. This level that the market is is testing, is eventually and gradually moving down. So that means that the market is very ready to embrace and taking the new bearish movement. So keep an eye for that when you're identifying your head and shoulders. When the neckline slope is up, that generally produces a less reliable signal and indication. Okay, do we have any questions up until now? We're waiting for your questions. If you have, just pop in. If you think of questions afterwards, don't forget that you can always send us an email later and ask us the questions afterwards, after the webinar. So here is a head and shoulder with a slope, with a down slope in action, which is kind of similar. The reason why we have the slope a little bit further down is because this bearish candlestick was formed a little bit higher. So you get into the sell position and you trade the market on the way down. So very similar to the triple top pattern. Same with the head and shoulders bottom, very similar to the triple bottom pattern. And again, over here now, if the neckline is slightly to the way up, it's slightly up, you see, this is the first valley, and the second valley is a little bit higher up. This is going to produce a more reliable signal as to the fact that the market is going to reverse and the market is going to go up, and you can enter your buy order. So here, we're talking about confirmation, right? So here, the market broke the neckline, and it was such a strong break that we didn't even have time to wait for a confirmation because the market was just going up. So what you could have done was to actually wait for the confirmation for the next session, the next period, or get into the market right about here. But in this case, be very careful if you don't have the confirmation within your single chart pattern. You do want to make sure that your other indicators are signaling the same direction. So in this case, are signaling an uptrend. We have talked about other indicators. We are going to cover other indicators in the next upcoming videos, webinars. So stay tuned for that. As I said before, these are just chart patterns, just one method of technical analysis, and you should not just rely on one of them when you're doing technical analysis. Last but not least of our 4 technical analysis reversal patterns are the saucers. So we do have a saucer top and a saucer bottom. The saucer top actually looks like an alien. You see the market goes up, it rounds up, and then it reverses to the way back. So the saucer bottom, it looks like a T saucer this time. The market goes down. And by the way, I did not come up with these names. If you're thinking that these are actually legit reversal pattern names, so we're not kidding around over here. So the market is in a downtrend. It rounds up a little bit at the bottom over here and then moves up. So one thing you want to remember about saucers is that they are generally formed in a longer time frames, and it takes longer for the market to form a saucer. This is precisely what we're talking about forex trading coming into cycles. So the saucer, in between the saucer, you can have a bunch of double tops, triple bottoms, and what have you, but the market kind of rounds up and then moves down. This can be a cycle over a year. And then when the market is exhausted of moving down, then it moves back up again. And the story continues. You see, it goes up, it goes down, and it goes up. All right, so that is a saucer in the longer term view. But again, it doesn't mean that you cannot use a saucer in the shorter term time frames. Here is a saucer top in action in the chart. You see we have a formation of a bunch of stuff over here. This is a quadruple top, this is a double top, a bunch of stuff. But in general, the market was moving up. And in general, in a longer term view, the market is rounding up. It's actually kind of consolidating, and then it went back down. Perfect for long-term traders. And there are 2 ways. There are different ways of trading the reversal patterns. Some people actually like to get into the market even before the market has confirmed the pattern. So for example, over here, I would get into the market over here, that would identify this level as a important resistance level, and they would get into the market over here and go all the way down. So there are different ways, but today we're specifically talking about how to choose your stop and limits based on the neckline and after the confirmation of the pattern. Same thing happens with the saucer bottom. This one actually is in a short time frame. The market was moving up, down. It consolidated for a period of time. So some people actually would like to would identify this as a rectangle. You see, if you don't see exactly it's rounding up, you might actually see that it is kind of slowing down. So it's basically the same thing, different names for it. A rectangle, a saucer, both of them the same. Both of them needs a confirmation above the neckline and are reversal patterns. So last but not least, as I promised, we are going to show you how to take profit and basically use the reversal patterns in a live market. So let me just go ahead and show you my chart right over here, and together we want to identify different chart patterns. Let me see if I have anything identified over here. Right. So let's see, what do we have here? Not on the dollar yen. Let's see if we have anything in the euro dollar. Tell me if you identify anything over here. Let's see how the market is moving on the Aussie dollar. So this is how you try to identify a trading opportunity. You go through the market on a daily chart, for example, on the dollar yen chart. Right now I don't see any specific daily chart pattern over here. Do you? But guess what? This could be the beginning of a formation of a double bottom, isn't it? The market was moving down. It went all the way here to this key level, resistance level is the 23% Fibonacci level. Now we have to wait for the confirmation. If the market do go all the way back over here and then show the signal that it's going back up, that would be the beginning of our double top. And as you can see here, I actually have entered this market. Why? Based on the Fibonacci analysis that we talked about yesterday, and now I'm even more sure. And I have set my stop limit over here at the end of a potential double bottom pattern, which coincides with the 50% Fibonacci level. You see, we're mixing and matching. The market is above the Ichimoku cloud, which basically means that the market trend is generally going to be up. So even if the market goes back down up until here, I'm not going to be worried, because there still can be some room for improvement and a chance for the market to go back up to a previous top over here. So as you can see, this orange line over here, the 23% Fibonacci level, and the 107.834 is the neckline of this potential newly forming double bottom over here. Right, let's zoom out a little bit and see if we had anything today coming up in an hourly chart. We did talk about the different candlesticks. We're still looking at the same dollar-yen pair, but in a different time frame. Oh, look at that. Does everybody see what I'm seeing? This is basically what happened before on the hourly chart. So look at this. The market was going up, right? And over here, we're going to add a horizontal line. The market hit this level. It went down. It went back up. It couldn't even make it to this level. It went down. It went back up, and it couldn't break above this level, and it went back down again. What does this resemble? I'm giving you time. If you thought this is a triple top pattern, you are absolutely right. This is the first top, and this is the second top, even though it's a little bit shorter, and this is the third top. And then the market, let's see what happened. Top and right, if you can see that the market, so we're going to identify the neckline over here. So this is our neckline right over here. So this is the top level. This is the neckline over here, and the market was going up again, up over here. And then around here, top and Y, you can see the confirmation of a break below the neckline right over here, right? So let me actually put it This is the confirmation of a break below the neckline, because even though the market was teasing this level for so many times, it was just shadows. And even though the market broke below it, I was still not sure about it, right? And then we saw the confirmation right over here. And then let's see what happened to the market. The reversal pattern was confirmed. If you did get into the market right over here, you would have made money up until here. And as you can see, this is the top, the highest top over here, and the market went down to the same amount as to the top of the triple top, right? The middle one. So this is how you make money in a triple top formation. You wait for a confirmation, you get in here, you get out here. Even though this is not a big move, as we mentioned before, the forex market has the leverage, and even though this is basically less than 200 pips over here, from here to here, right? Let me actually identify it for you right here. So what we are talking about is getting into the market after the confirmation over here and making money up to here, right? Even though this is not a big pip making for you, if you have your leverage set up for you, you can make money even with this small movement. So this may not have been the best example of a triple top, because even the market was not exactly the same price, and you could have made a mistake with identifying the measuring the distance between the top and the bottom. But still, if you were quick enough, you could have made money and got out of the market soon enough. But at the same time, the reason why this specific one wouldn't work out just with the triple top pattern is because you're only using the triple top pattern. If you were actually using Fibonacci or other forms, you would have actually you were likely to get your limit and your exit strategy more accurately and get out of the market before getting burned. So once again, just to wrap up, this was the dollar-yen hourly chart, right? And the market is still consolidating kind of over here. We are waiting if you zoom out to the dollar-yen daily chart, where each of these candles are made in one day. You see, this was where we identified the triple top. But on a daily chart, it's not even visible because each of these candles are made in one day. So it basically depends on your trading strategy. If you're a day trader, you want to trade on an hourly chart. If you're a more longer-term trader, as I am, you want to use a daily chart or a 4-hour chart and make for the markets to move in a longer period. It is about time. I'm still going to be here for another minute. If you have any questions, thank you so much for watching. Let me go back to our Orbex platform. If you have any questions, don't forget that you can always contact Orbex at info@orbex.com. If you have a question specifically for me, they will definitely forward it to me. If you want to mail it directly at me, just go and send me an email at kiana@investdiva.com. Either way, we'll be happy to answer your questions. And thank you for watching. I really appreciate you being here today, and trade responsibly.